Cole, I'm back with the panel. And by the way, I should point out that Cliff Noreen, our friend, our chief investment officer over at Mass Mutual Financial Group, emails that, this began back in March 2009. So we have been dealing with this asset purchasing by the Fed for quite some time now. And this is indeed an economic experiment. It really is. And it's historic because now for the first time ever, a central bank is now committed to winding down that portfolio. They built it up. They got to wind it down. And what is that going to mean for interest rates? He said the hope is if they can do this effectively, then that means good stuff for the future, because that tells you that, the Fed's tinkering might actually work. But, Adam, you know me well, and sometimes I get a little nervous when we start talking about the Fed and their confidence, shall we say, in their ability to tinker.
Well, I think what you're getting at is where's the free in free markets, right? If you had the Fed come in and buy all this stuff, and now you have the Fed not only unwinding it, but telling us exactly what it's going to do this year, next year, 2019, and even into 2020. Are you kidding me? There's nothing free in free markets about a Fed that's giving that much guidance. So I think what you're getting at is, we want them to get it right, but maybe, people too.
And I never liked the fact that they had to be so involved. I mean, I get it back in 08, right? Those were scary times, and you do what you got to do at the moment. But QE1, QE2, QE3, I mean, at some point, you've got to give me a break. And I've been warning forever, you're going to get stuck with a real problem. Well, that problem, that day is here, and there's confidence that Janet Yellen can figure this one out. But Douglas Holtz-Eakin, I never liked trusting the academics.
Hey, look, I think your sentiment's exactly right. You can look back and ask, why did we do this, given that we never really got any improved growth out of it? That was the fundamental purpose of the program, and didn't seem like it worked to me. I think going forward, there are two really important things going on today. Number one, the Fed statement as a whole is a pretty optimistic statement. It says we're unwinding and we're going to go to the hawkish end of the rate increases for 2018. And that sends the message they at least think things are fine. And number two, this sets the baseline for whoever is the next Fed chair. They will be measured relative to this. If they do more than this, it'll be only moderately hawkish, whereas if they do less, they'll be viewed as a very big dove. And so this really does frame the Fed debate over the next year, and they've set in motion the unwinding and the expectations.
Well, let me ask
Those are important things for the Fed to do.
Let me ask this. David Nelson, I mean, now that the Fed is out on record, right, and they've made this commitment to 10 to 20, 50 billion, they've said that they're going to raise rates in 2017 once, they're going to raise 3 times in 2018. If they don't follow through with any of this, if they start to back off and they say, well, things are changing, things are shifting, does the market start to freak out because they're like, wait a second, guys, you promised one thing and you're not following through, you're not doing it? Perhaps that suggests that you can't really unwind a balance sheet at this size.
If they start to back off, it's likely because they're seeing something down the road in the economy, and that will spook the markets for sure. That's really the risk here. And that would be really, from my perspective, the only thing that would get them to slow down here. I think they're focusing on the right areas, certainly the balance sheet. Certainly on one half of the dual mandate for inflation, we spent $4.5 trillion trying to get some form of inflation. Obviously didn't work. So let's walk away from that at this point.
I'm glad you brought that up. And Heather, you can elaborate on this, too. Again, $4.5 trillion is a lot of money. That's basically a quarter the size of our annual economic output. That's a lot of money. And it didn't really get us anything. In fact, if anything, Heather, it contributed to the hourglass economy that we find ourselves now in, where those on top, they benefited. Because if you have capital, you can make that go to work for you, and the markets have been on fire. And those on the bottom increasingly have seen government handouts, but those in the middle, Heather, they have been squeezed. And I don't think this Fed program has done one darn thing to help them.
Yes, I agree with you. The other side of that is those that are long the market would say it's pushed people into riskier asset classes like stocks because you're not getting anything out of your bond portfolios. If you're in retirement, how do you get anything from savings or CDs at 0%, 1%? 2% on the 10-year. You can't, so you're forced to buy stocks. It's helped prop the stock market up higher than perhaps some would argue it should be, Trish. So this is an unprecedented time, uncharted territories. And globally, remember, central banks around the world are still printing money. Even though in the U.S., where it looks like we're ending that program, we are going against the grain here. There's still $12 trillion around the world on a global global scale that also needs to be unwound.
That's a good point as well. You know, look, the one thing I'd say during this whole process is I was bothered when you had retirees suddenly looking at Puerto Rican debt and saying, hey, you know, maybe I can get a 10% yield on Puerto Rican debt, only to find out that Puerto Rico was going to default on its debt. I mean, that's what it did. It basically took your average mom and pop investor and it forced them increasingly to look at riskier and riskier vehicles, because how else were you going to get any kind of yield? And there are consequences to that.